The price increases are real. It's causing real damage, but it's nothing the Fed can do anything about. But every day you get a little closer to that demand pull. You get a little closer to that change in psychology. We're not there yet, but if this supply side inflation persists, we may get there, and then forget it. Now you're on your way to 15% inflation. I've never said that the Fed will never pivot. My point was they'll pivot too late. They'll pivot. They won't pivot when the market expects. Right now, the expectation, maybe it's cooled off a little bit, but the expectation was that the pivot would come as early as January or February 2023. Or some people were even saying December 2022. That's the signal that the inverted Eurodollar futures curve is sending. But as I said, it doesn't mean the Fed gets them. Is the Fed looking at Eurodollar futures? I don't think so. I think they're looking at the Phillips curve, which is a joke, or looking at the unemployment rate, which is misleading. And I love it when the employment report comes out and says, wages were up 5% on an annualized basis. It's like, yeah, that's nominal, and inflation's 8. So you're down 3. People are losing money. But so yeah, the Fed will pivot eventually, but it'll be too late. It'll be after the damage is done, after we're in a deep recession, unemployment rising. Because remember, they've baked higher unemployment into the pie. When unemployment starts to go up, and I believe it will soon, they're going to say, yeah, we told you there's going to be some pain, and they only look at the unemployment rate. They're not looking at labor force participation, which we talked about. So if unemployment goes from 3.5 to 4, 4.25, 4.5, that is not going to be enough to dissuade the Fed. That's not going to get them to stop raising rates, because they're only worried about inflation. Now, there's some level where they'll care, but is that 6? I mean, it might be 6%. But when we get to 6% unemployment, we're on our way to 8. I mean, that's where the wheels are coming off. So inverted yield curves are signaling January. The Fed's not looking at them. The Fed doesn't care. The Fed doesn't understand them. The Fed has got one goal in mind, which is to kill inflation starting at 8. And by the way, we haven't even talked about the fact that this inflation is cost push. It's coming from the supply side, which is completely different than demand side. I lived through the 70s. It started as cost push with the Arab oil embargo and quadrupling of oil prices, but it flipped into demand, what's called demand pull, which was, that's a little more like too much money chasing too few goods in the late 70s. So we had both, but we had them sequentially. So right now, the inflation is coming from the supply side. It's coming from energy price increases, which are obvious, shortages. And the problem in Europe, I wrote the other day, I said there comes a time when the price doesn't matter because you can't get the energy at any price, where it's actually, there actually isn't any. Bid whatever you want, but there just isn't any. And Europe's getting close to that point. But as far as monetary policy is concerned, the Fed doesn't drill for oil. Fed doesn't drive a truck. Fed doesn't plow farms and pick corn and all that stuff. They can't do anything about it. What they can do is destroy demand, but because it's not coming from the demand side, you've got to do like twice as much destruction to really cool off the supply side. As I say, in the 70s, it did flip. And again, going back to the narrative thing, demand pull inflation is scary, because the name comes from the fact that you're pulling demand forward. And I remember in the 70s, if you wanted a new car or refrigerator, you said to yourself, I better go buy it now, because it's going to be more expensive 3 months from now or 6 months. It's going to cost me a lot if I wait. That is not true today. That has not kicked in. The inflationary expectations are not up that much. People are feeling the price increases. Real CPI. There's no doubt about that. But people have tended to say, yeah, that's really bad. And if I got the demand for gasoline is kind of inelastic if you got to go to work or drive your pickup truck or whatever. But the way people afford it is they say, well, we're not going out for dinner this weekend, or I'm not going to buy a new winter wardrobe, or we're not going to take a vacation. So you do destroy demand in other sectors, more elastic sectors than oil, than gas and diesel. The price increases are real. It's causing real damage, but it's nothing the Fed can do anything about. Now, every day you get a little closer to that demand pull. You get a little closer to that change in psychology. We're not there yet, but if this supply side inflation persists, we may get there, and then forget it. Now you're on your way to 15% inflation. Here's another irony, having just resurfaced from a deep dive in the supply chain. There's something called the bullwhip effect, but so go back to last November when their shelves were empty. Not every single shelf in every single store, but selectively. Where's the paper towels? Where's the hot sauce or whatever? And you just couldn't get stuff. And that's still true. It's moving around a little bit. It's going from cream cheese for cheesecakes to baby formula, which is much more serious, but you still can't get the baby formula. So what did retailers and what did distributors do and wholesalers? Well, they said, I'll triple my order.
Right.
Because I can't get any, or I can't get enough, so I'll triple my order. Well, now all of a sudden, some of the bottlenecks are being relieved. The triple shipments are showing up, but the demand has collapsed for reasons we've discussed. So now the warehouses have gone from empty to being full to the rafters, but you can't sell the stuff because the economy's slowing down. So what do? You cut prices a lot. And first of all, you don't order anymore. So that feeds back to the factory level. So shutting down the factories, and we're seeing that in China. It's very expensive to maintain inventory because you got to finance it. And interest rates are going up. We talked about that. So what you do is you cut prices. So tell me what that does for retail margins. The Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in last fall, late 2021. November 2021, Jay Powell says, time to retire the word narrative. He actually said that in transitory. So time to retire the word transitory. I think he said that in some congressional testimony. And then inflation goes to the roof, January, February, March, April. The stock market goes down. NASDAQ started going down actually in last November. Dow, S&P started to go down in January, and we're in a bear market by June. It's still going down. But then after the Fed raised rates in March, May, and June, and then the yield curves inverted, and some people weren't looking at them, but some people were, the narrative's like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower 6 months from now. Inflation's cooling off a little bit, and it has. The price of gas has come down a little bit. And so they're going to have to cut rates. That was the pivot. They're going to have to cut rates in January, February, and rate cuts are good for stocks, so buy stocks. But then we get this rally in July and August, and the stock market's, recovering a lot of this, not all the lost ground, by the way, but a lot of it, all based on the Fed pivot narrative, which I never bought into. I mean, you don't want to stand in front of a moving train. I wasn't going to short the S&P, but I did not buy into the narrative. I said for two reasons. Number one, inflation came down from 9 to 8. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks. And it's not. But the other reason is, and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, it doesn't mean the Fed's going to cut. I mean, that is the message. But it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. Of course, this call comes to a head, I think, August 26th at Jay Powell's Jackson Hole speech. I've never heard a Fed chairman, been following this a long time, never heard a Fed chairman use the word pain twice in the same paragraph, but he said, this is going to cause pain, it's going to be very painful. And then, so that kind of burst the bubble of the pivot narrative. And then the stock market goes down, I think, 6 straight days. So what's going on now? I don't know. Maybe a little short covering, maybe, the buy the dips crowd have not gone away. They're still around. I'll say talking heads, I guess I'm one, but, the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those. A lot of those actually, but the fundamentals have not changed. The recession is here, or if we get a little breathing room, it's going to go down really hard this winter. All the problems we talked about, and most importantly, Jay Powell told us. I always say that forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. You just have to listen and know. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash.